Welcome again in continuation of trading analysis. Remember, guys, this is a complete course. So if you haven't checked part one of the video of introduction to trading analysis, where we talked about major branches of trading analysis and how it helps you answer these questions and why analysis matters. So I'm gonna go ahead and remove this one so we can move to the next part of this topic, trading analysis. So, as I had mentioned earlier, that I might not be able to cover all this in one single video about core pillars of technical analysis, timeframes, risk management, building simple, beginner trading method, and psychological focus in a single video because I want my video to be a little bit shorter so that you guys can be able to take notes and catch everything correctly. So that being said, in this video, I'm going to be talking about core pillars of technical analysis. And we're going to be talking about market structure. We're going to be talking about support and resistance. We're going to be talking about supply and demand zones. We're going to be talking about candlestick patterns. We're going to be talking about indicators, timeframes, and note, guys, I am an ICT trader and I have my own concepts which I use, which have been, they work well with ICT concept. But as you can see here, I'm talking about market structure. I'm talking about support and resistance. I'm talking about supply and demand. I'm talking about indicator, candlestick patterns. And a lot of traders out there will tell you that people who trade support and resistance are losers. People who trade patterns don't make money. But ask them to show you their bank accounts, right? I know of people who only trade support and resistance. I know people who trade only candlestick patterns and making big money. So that being said, guys, I have advanced market strategies, but even with my advanced market strategies, it still works. This one works. The only advantage I have is that I can easily spot when something is not right with the advanced, market analysis and so on. I can easily spot. You see, for example, right now, if we do a trend line here, let me give you guys a good example. When you do a trend line right here, like this, so it has been, this is a breakout. Then for people who understand ICT fair value gaps, this is like a strategy you can use. You enter on that gap, okay? That bearish one, okay? Then now after entering here, let me show you a little bit. You enter there. Your stop loss is going to be above this high. Then you're going to be targeting this opposing liquidity right here. But unfortunately, guys, it's not going to come down here. There's very low probability that we are going to take this low. So for you to understand that, you might, even if you understand ICT, you need to have some other thing, confluences on your mind. With my bias, I'm expecting price to take out this low. Once you take out this low, then you're gonna reverse. We start going back high again. So meaning that those who have put their stop loss right here, waiting for this to be taken, they're gonna be stopped out. Anyway, I don't want to go deeper into that, but this just to show that even the breakouts do work. The only difference is that when for you to fully understand this market, you need some advanced market theory or some advanced market systems. So that being said, let us get into the video. I once did a video about market structure. I think about it is right here in this channel. And for those people who have not really checked it out, I'm gonna advise you to get some time and look into it. So I want us to just to talk, shallow about it, especially for the new, traders who came to follow this course or lecture. So, in a market structure, this is how price moves. Price moves in market structure. It moves in a waves of highs and lows. Okay, and in that video, I talked about candlestick, how we create the highs, lows, open, close, and so on. Right. So, in market structure, the most important things you'll need to learn how to identify higher highs and higher lows. And higher highs and higher lows simply means uptrend. So let me give you guys a good example here. This is a higher high. This one is a higher high because it is the high compared to this high here. So this high is higher than this high here. So it is a higher high. This is higher, but this is higher than this. So it is higher high. This one is also a higher high, okay? Because it is higher as compared to this one. So that's how you mark higher highs, okay? But also, when market is creating higher highs, and giving you higher lows, that is automatically an uptrend. Higher lows are going to be this low here, this swing low points. Okay, these swing low points here. So for example, this is going to be a lower low compared to this one here. Okay, but when it comes to this one, this is now going to be a higher low because it is a low that is higher than the low of the lowest. Okay, low according to this area or according to this specific day. You see that? So this is going to be a higher low. So when price is creating higher lows and creating higher highs, definitely we are on an uptrend. So once you learn that this is about market structure, that's how you mark the higher highs and higher lows. Okay. When you're on a downtrend, it now becomes the opposite. Now let me show you guys a little bit about the downtrend side of it. When you're on a downtrend, for example, let's talk about this one here. Let's just use this day here. So we're going to be creating lower lows and lower highs. So we're going to create lower lows like this one. These are lower low because it is lower than this low. Okay. And also on the other side, we are going to have another lower low right here. There's another lower low. There's another lower low. Okay. Because all this low, this one is below this one. This one is below this one. This one is below this one. It's just something, this how market structure is. When you're creating lower lows, meaning that you're in a downtrend. If the market keeps giving you lower lows, like this one here, is a downtrend. But the moment it shifts, instead of creating a lower low, though you had a low low here, it now starts create a higher high, which is this one, compared to this high here, then that shows a shift in market direction. This is how you read. These are just the basics, guys. I'm not going into deeper factory issues like fair value gaps, inefficiencies, volume imbalance. I'm not going to go into that right now. This is just for beginners, for people who really want to get to understand how market structure really works. So on the other hand, you're also seeing that we're having lower highs. So lower highs is, for example, this will be a lower high, this one here, because it is a lower high compared to this one. It is a high of this specific structure or specific zone. It is the high and this is the lowest, and it is a high that is below another high. So it is a higher what? It is a lower high, okay? So that's just it. And also we have this one here. This is also another lower high because it is lower as compared to this one. So it is another lower high. Okay, so that is how you read market structure, guys. So when you talk about trading analysis, I hope you guys are enjoying this so far, and if you have any question, don't hesitate to leave a comment and tell me what it's about. So market structure is gonna help you to know the direction of the market. When you see higher highs, you see lower lows and so on, you're able to know the direction, like we are going either uptrend or downtrend. Or in other terms, sometimes it's consolidation. Consolidation is a situation whereby sometimes I like calling it undecided. For example, yesterday, I know a lot of us lost a lot of money here. There was this time when gold was doing something, this area. If I move into a lower time frames, maybe like 15, you'll be able to see what gold was really doing here. This one here. You see this zone, let me mark from that high to this specific low here. Or maybe let me make this range. You see this one here. This was really chaotic, very, very chaotic. But I understand what was going on. Trust me, I knew what, like, I'm not really going to go into details about that. But either way, this one here is now what you call consolidation, meaning that the market is spending so much time. You see, from 12:30 to 16:15. Imagine those hours. It is just here consolidating. Okay, so this is the type of areas whereby, or type of trades where you avoid trading because it was just collecting liquidity here. Then now it drops lower. So when dropping lower, people would some people thought that now we have a break of structure, so we are going to be selling. Okay, some people thought here now we have a break of structure, but they don't know that this was an inefficiency being balanced here, right here, before price just balance it, then we start going higher. So even today, I'm expecting us to go higher, but I would like to see us drop below here, do some damage here, then we go higher. And I know some people are thinking of selling based on market structure and so on, but guys, everything takes time. You're not going to understand this market just the same day and be able to, just get to understand it from head to toe. So it's going to take some time. Give it time. So apart from that, let's talk about support and resistance. So support and resistance, these are just, price levels where prices are historically, reacted, and support most of the time just bounces upward. Then resistance, sometimes it's just price reject downwards. And I won't really like to go so much into this because I'm not really a support and resistance trader, but I know I do understand how it works. So for example, let me give you guys an example here. We're gonna be having this zone. So based on what I told you guys, this is now support. But on this other side, it was resistance because price was kind of rejecting that specific. Yes, so just from the basic understanding that with support, price is going to be bouncing upwards. For example, this one was support. So price is coming, it is being supported right there. Then resistance is price is going to be bouncing downwards. So if you're a trader who was in trading resistance, so for example, as you can see, this one was resistance right there. That level was resistance. Okay, because price has reacted to that level historically for quite some time, and maybe if you trace back on this other side, you might be able to see some reaction again. And as I said, guys, I'm not a trader of support and resistance. I'm just doing this so that those new beginners, it is just good to note these things. Okay, so when you leave that behind, we have the supply and demand zones. Supply and demand zones. So supply and demand zones, they're just other terms for premium and discount. Okay, this is just institutional zones whereby powerful buying or selling areas are often initiated. So in other terms, it is just ICT concept. We can call them premium and discount. Okay, so when in demand, a strong rally will start. Okay, and when in supply, a strong drop is going to be starting. So trading become easier when you follow where big money is reacting from. So for example, if you understand that let's say this is a demand zone. Let's say this is a demand zone. For example, here this was a demand zone. So after in this area, so in other terms, we can call it discount. So a strong rally up. Okay, but now when it goes to supply up here, which is now premium, then a strong rally, no, not rally, now there's now a drop. A drop is now coming in. So just follow where the big money is, and these are just the basics. These are just the basics of trading. I'm trying to make it easier for anybody who wants to start trading. Maybe these terms are confusing you and you are like, what exactly? If you have any question, don't hesitate to reach out. Leave a comment. I'll be able to get back to you. And when we leave supply and demand, we're gonna go to now candlestick patterns. Now candlestick patterns, sometimes or maybe, but I like using the word sometimes because there's nothing like 100% with trading. So these candles, they usually show the battle between buyers and sellers. For example, you can see things like rejection wick, like this one. These are wick. For if you're like completely beginner, you don't even know what a wick is. A wick is this part. This one that looks like a stick. This one, this is the wick. Then this one is the body. Okay, but I don't think I have that type of trader in here. But in case you are, maybe you can leave a comment and maybe I'll create another, complete beginner, to what candlesticks are and so on. But if you understand, for example, a rejection wick like this one here, things like engulfing candles in, inside the bars and so on. So candlestick patterns are part of market structure. Okay, they're part of they all fall under the market structure of like how is price reaction or price action in other terms. So when you leave that behind, when you go to the indicator side, because I'm saying I don't want this video to go too far. Indicators, these are just from the word indicator, often found here. Okay, so indicators are just things that help you confirm that either you're right, but indicators is not what is going to make you win. You must have a strategy. They just help you to confirm or maybe to get you to understand levels. For for example, maybe, or maybe time frames, or maybe some specific. So, for example, you can use an indicator like the ICT kill zones, whereby it shows you accumulation, manipulation, distribution. So instead of you coming manually and starting to mark them out from this time, from this AM to PM, that indicator makes the work easier for you. So it just marks them. So that's the purpose of an indicator. Okay. There are some other indicators like, RSI, the moving average, they call it the trend guide. Those are things that I've used in the past. I mean, the past, but I don't use them anymore nowadays because, the more you grow, the more you get to learn, and the more you learn, like we're in the process of growth. And lastly, when we talk about time frames, in time frames, big trends form on high time frames. Small entries happen on low time frames. Always on higher time frames, for example, when you click on the daily is supposed to be giving us the overview. Like this is for analysis, for us to understand the overall market structure. Like, where are we headed to? What's really happening? Then you're gonna move into lower time frames, like maybe 5 minutes or 15 minutes or 3 minutes or 2 minutes or even one, to get your entries. But always, for a strong approach, use daily time frame or 4 hour time frame, 4 hour or daily time frame for overall direction of the market. Then 1 hour or maybe 30 minutes is just to refine it. Then now when you move into 5 minutes or maybe 1 minute, is now for entry. That's where now you pull your entries, because now everything aligns with your analysis. So that being said, guys, we've talked about the core pillar of analysis, and I'm saying this video is a little bit longer. I said only 10 minutes. That's why I cannot talk about all these other topics in the same concept. So that being said, I hope to see you guys in the next one. So if you have to watch the video to completely understand, just do so and leave a like, subscribe, share with a friend who wants to learn about trading, and make sure you learn the first topic or the first chapter of this trading analysis. Remember, we are talking about trading analysis for beginners in this series. So see you in the next one. Cheers.